Hey, what's up, y'all? My name is Carlos, and I am a mortgage loan officer here in the Dayton, Ohio area. And today I want to talk about VA loans and bad credit. I got a lot of questions from people asking me if it is possible to get a VA loan if you have bad credit. And it's a great question. And so I want to go through this real quick and talk about VA loans and bad credit and how you can get a VA loan with bad credit. The VA loan is actually extremely flexible, and they actually do allow people with bad credit to get VA loans, but there are a few things to keep in mind. Now, one of the things that you should know is that the VA does not write the loan. They just write the ground rules and the insurance. So the VA is not a lender. Mortgage companies are lenders, and that makes it one of the most flexible loans out there. And so one of the things you need to know is lender overlays. So what is a lender overlay? A lender overlay is where a lender creates a rule on top of what the VA says. So the VA sets the ground rules, and then the lender might have a rule on top of that. So, for example, one of the big rules with VA loans is no minimum credit score, which is really cool. Now, that doesn't mean everybody can get a VA loan, but that does mean that there's a lot of flexibility in that. That being said, like I said, there are lender overlays. And so some lenders might say, we have an overlay that will only approve people at 580. Some might say we only approve people at 500. And some might say, you know what, we look at certain things on the credit and decide that way. Now, that being said, there are certain rules on VA loans you have to know. For example, if you do have a bankruptcy on credit, it's pretty hard to get one with less than 2 years after your discharge. There are a few exceptions with only a 1 year discharge, but they're extremely rare to get approved. So generally speaking, you have to wait 2 years after a Chapter 7 discharge. Now on Chapter 13, it is a little bit different because that goes based on the file date on when you start your repayment plan. So on a 13, if you had that 13 and you've been making payments for at least 1 year, and you made 12 payments on time on that 13 repayment plan, then you actually could get a VA loan. Foreclosure, another big one to keep in mind, you got to wait 2 years after the sheriff's sale on a foreclosure. Again, there are a few exceptions where you can go as little as 1 year. Both those are pretty rare and very hard to get approved. Now, one of the other things to keep in mind with VA loans is there are two different types of underwriting. There is automated underwriting, and then there is manual underwriting. Now, automated underwriting is a lot better because there is a software program we call the automated underwriting system, or AUS, where basically we put all the information in and we check a box and it either says yes or no, you're good to go. Now, sometimes the software just doesn't like the file for whatever reason, and then we have what's called manual underwriting. Now, manual underwriting is really interesting on the VA side because the VA actually is super flexible with what they allow. And then actually in the VA handbook, it actually says underwriters are encouraged to consider every possible appropriate factor in seeking a proper basis for approving loan applications for every qualified veteran. As long as lenders document their reasoning, it is extremely unlikely that VA staff would ever take issue with their decision, which is really great. Now, that being said, lenders don't want to just randomly say, well, this person's approved, this person's not approved. So lenders do set their own standards on the manual underwriting. And here are some very, very common rules that you're going to be seeing when you see manual underwriting. So, for example, I rarely have seen one that has been approved with any collections within the past year. That's pretty standard because they want to make sure that whatever you got has been resolved. The other one that is huge, and the VA handbook actually does address this, was explain the reason for delinquency and show that the reason has been resolved. So, for example, if you got laid off and you can show that you were laid off in this date and this date, now you're back to work, and you have paperwork showing exactly what happened, when it happened, and now you're a responsible borrower, there's a very, very good chance you're going to get approved. This also happens a lot with medical debt. So for example, somebody got injured doing whatever, and they were out of work on disability, and all of a sudden they ran up $100,000 in medical bills. Then, and you can show that, oh yeah, you're back to work now. Everything's been resolved, and you can show through the history of your medical bills that you can show, okay, the accident happened this date. Here's what happened, and here's all the documentation showing it's been resolved, and everything's good to go. I'm a responsible borrower now. There's a very, very good chance it's going to get approved. The other thing that the VA looks at pretty closely on these, or lenders look at pretty closely, I should say, debt ratio. Now, the VA doesn't really have a debt ratio requirement on the manual underwrite, but it's very, very hard to get a manual underwrite approved at over 50% debt ratio. I've seen one lender that goes to 60, and even that's a very, very special case. Once you get over a certain limit, it just becomes slim pickings. And, me as a broker, I do have 110 different options to choose from, but the options get a lot slimmer when it's over 50% debt ratio for sure. So what is a debt ratio? So for example, if you have $2,000 in debts, which would be the mortgage debt for the new house you're buying, plus all your other debts. So for example, you're making $4,000 a month in gross income before taxes, and at $2,000 in debts, that's a 50% debt ratio. That's how that's calculated. And you can adjust accordingly based on your situation. The other thing that they will look at pretty closely in any VA loan, but especially on the manual underwrite, is something called residual income. And so I'm going to give you a quick chart on residual income real quick. So residual income is your take-home pay minus your other net income, minus property tax, the payment with special assessments and HOA, monthly maintenance, and that'd be utilities and that kind of stuff. And basically, it's seeing what you have available to spend for your family. And so, for example, and this is outlined in the VA handbook. And so, for example, if the loan amount is $80,000 and above, I'm in the Midwest, they also would look at family sizes on this for residual income. So, for example, with a family size of one, just the borrower, no kids, no spouse, they need $441 a month after, basically from your take-home pay minus expenses, $441 a month, and it becomes a family of five, becomes $1,039 a month. And so, ideally, on a manual underwrite, you want it to be much higher than that, and the more it's higher, the more the residual is higher than the minimum standards by VA, the more likely that would get that manual underwrite approved. So those are some basic standards for bad credit VA loans. As always, if you have any questions or comments or concerns, please reach out to me. My number is 937-572-3713. I can also reach at scarpro.com. I am licensed in 9 states currently. I have access to about 40 states. And even if you're outside of those areas, I have contacts all around the country that can help. So I look forward to talking to you soon. Thanks. Bye.